This is PifI, and no one knows his real name, nor will we ever. So
Papa Pickle, that's his real name.
So they're not using a physical locate when they're doing creation. And I think based on that, if you guys saw that same DD, I'm sure you saw the SEC report that I linked regarding that. I'm not sure if they're actually using like the DTCC's ledgerization to prove the existence of the share beforehand.
Can I assault you with a T-chart, PifI?
Yeah, go
like
for
right
it.
here. So like right here. So this is me trying to make sense of this, and like the one thing that I think has helped me understand it, assuming my understanding is correct, is for the liability side, from XRT's perspective, because it's an open-ended fund, they can theoretically, I think, issue as many shares as they feel like issuing. That's why I've got this dotted line.
Limited by the number of shares outstanding, of course.
And so when XRT basically creates these shares are essentially a liability from XRT's perspective, backed up by the various assets, the GME, Company A, Company B, et cetera, or whatever, right, that they've got on their balance sheet. But those shares themselves, I think, are in turn just IOUs from the DTCC.
I mean, they have actual ownership. Like BlackRock and Vanguard, most of their holding in GameStop is ETFs. So the ETF has a physical basket of stocks that it owns, that it draws from. I'm not sure how the DTCC views that physical ownership or the rehypothecation thereof, but yeah, they do own physical shares as part of balancing their NAV.
Good. So I'm not saying that they don't own physical shares, but rather are the shares that they own, are they directly registered in the name of the fund administrator, or are they held in CD?
Probably not. Yeah, I would imagine that they would be just openly ledgerized through the DTCC. I don't think they would be held in street name for the fund, maybe for the owner of the fund, because like BlackRock has its GameStop shares registered in BlackRock's name, right? But they're not registered individually across all the ETFs that they're actually in.
So my thinking is that if you have XRT, which will then generate shares that then sit on the DTC's book, and then if the DTC itself will issue IOU shares from the XRT shares, am I thinking about that correctly? Like this middle part right here? So in other words, like when someone buys, like when you and I buy XRT or whatever, right? What we really get is this IOU XRT share, which theoretically is backed up by a real share that was issued by XRT to the DTCC.
So I like to think of these XRT shares more as like a fractional share, right? In the way that it represents the ownership of a portion of the asset basket the ETF holds. And that's why theoretically ETFs have unlimited liquidity, because they can issue as many shares of that asset basket as they want at any given time. And you'll see the float size of these ETFs increase and decrease on a daily basis. Because like an ETF share isn't really a true like share of a stock or a company would be, right? It doesn't represent a percentage ownership of the ETF, but just the underlying securities basket.
So that's a follow-up question to that. If it represents an underlying securities basket, they could the fund could issue more shares than they actually had underlying for, assuming they did whatever they needed to do to demonstrate that they would eventually take delivery of the various underlyings, right?
Yes.
And that's where forwards come in, because if you have an obligation where they cannot get out of acceptance of the stuff or whatever, right? That's how they're able to cover their ass. Okay.
That's correct.
From the vibe that I get from the DTCC is that they know what's going on, but they just want to have plausible deniability. I mean, I can't read minds or anything, but that's kind of like how I conceptually think about it. And so my thinking is, actually, let me show you this one right here. Every time more shares are issued that are ultimately backed by the DTC. So you have the synthetics that are created or whatever, right? I think that means that the DTCC's balance sheet ultimately expands. Now, other balance sheets might expand too, but I think this expands the DTC's balance sheet, because on this side right here, you have the liability of IOU GME shares. But on this side right here, you also have what the DTCC is due from whoever is authorizing or telling the DTCC to create these shares. Like, hey, listen, DTCC, you're able to go and create these phantom shares because we, the counterparty who's short, we have, we can check off either through continuous net settlement. We have these, forward or whatever, right? We have some collateral to cover your ass, DTCC, so you in turn can issue these, phantom shares to whoever.
Sort of. I mean, I think the issuance of the shares is separate from the DTCC, as I've understood it. ETFs are still. I mean, there's a lot there to unpack that I'm still learning. I think the DTCC is simply used to facilitate a locate to prove the existence of the shares in the event of operational shorting, but not in the event of creation. And so when you're using creation, you're not shorting. There is no locate, right? Because you're just creating a share based on the holdings of the ETF. And so in this instance, Like this is the way you would normally facilitate a short sale, right? Going through the DTCC, ensuring a locate, setting up a share lender or share borrower agreement, and then moving forward with the short sale borrow and then the short sale itself, right? But with the ETFs, the ETF is acting independent from the DTCC. The ETF is saying, we have these shares, we can create them.
Yeah. And that would kind of be the same thing with the Fed. The Fed's balance sheet may be $30 trillion, but if you look at the entire dollar supply in circulation, it's well over 30 trillion going offshore. And yes, they may be able to back that up if they need to, but they don't see that on their balance sheet. And that's kind of the same way that I see it with the DTCC, because I don't think that they know how many shares of GME are actually out there.
But with continuous net settlement, those shares of GME that are out there as on the ETF side don't continue to exist, right? While the obligation for those shares may, be represented, there's a failed transaction receipt that gets shuffled off to the obligations warehouse. They just never deal with it, essentially. Other than that, that net settlement process clears out those FTDs because the FTDs aren't on GME specifically. Like, even though the FTD may represent one share of GME due to the ETF, the FTD in itself is an ETF FTD, which can be settled through net settlement because ETFs don't have real shares. They have an unlimited float. So any number of FTDs can always be cleared.
Can I ask a quick follow-up to that? And the reason that ETFs can be open-ended and have unlimited shares is because if an ETF suddenly sells in the twinkling of an eye, 100,000 more shares, whatever, right? The ETF will have some period of grace in order to buy the underlyings, or at least show that they have entered into contracts where they will acquire the underlyings.
Yeah,
right?
T+6. Yeah, okay. It's actually T+5. 6 is used as, it's kind of a misnomer. 6 is used because they have till the following day at market open.
Gotcha. Yeah, and so that's.
But the regulation is now T+5, not T+6.
Oh yeah, so oops on that one. So the other thing I was thinking about on this is that if these guys, whoever wants to do it or whatever, right, there's got to be like some enforcement or some check mechanism. And I was telling Josh this earlier. It strikes me as like the teacher from school or whatever that's just checked out, that just doesn't care or whatever, right? In other words, like the teacher only wants to see their students do well on the test, and even if they cheat their ass off, who cares? Her metrics or his metrics are going to be satisfied. But the teacher can't look like they want the students to cheat, but the teacher says, oh, well, I'm only going to look over here, and then I'm going to look over here 5 minutes later or whatever, right? It's kind of done with this wink and a nod, so the market, or so the students know kind of exactly how to get around the system. And so my thinking on this front was that, so again, like I said, I try to think in terms of collateral. Like, okay, if you're going to create this phantom thing over here, whoever's doing it, you've got to have something over there, theoretically to offset it, or at least just the promise of something to offset it. And so this is the best way, or this is my best representation I've thought of so far to describe it, is that if you just have like a very simple like IOU share or whatever, right? So like every time like you get more and more, or you need to hit the synthetic more and more and more, you get more and more exotic. My guess is, I'm just curious to kind of see if this passes the smell test. The collateral that's supplied to offset whatever's created might get more and more wacky and more like not out of sync, but exotic is my kind of my go-to word to describe that. And the reason that any creation or any new issuance of whether it's X or T or whether it's synthetics GME or whatever, right, have to be backed up by the collateral is that I would assume that the DTCC, they might be negligent, but they're not stupid in the sense that they don't want to be left holding, or they want to do what they can to not be left holding the bag. So okay, listen guys, you have to post at least something or whatever, right, in order to back up your position saying we're good for it.
I'd imagine the APs hold collateral on hand with the ETFs that they're working with for these creation baskets. Either that or I'm not sure how they do their same as cash collateral. Is that not through FINRA, through their margin requirements for FINRA? I know they provide collateral to the ETF itself, but I don't know how much of this process is actually in the DTCC's hands. I mean, the DTCC doesn't serialize shares, right? So as long as shares exist, then they are shares, right? Synthetic, real, doesn't matter. As long as they can show a balance of shares on their ledger, then those shares can be created through the ETF because there's no serialization in the process. Even though the shares are in fact serialized, they don't pay attention to it.
So would I be correct in thinking that the author, or backup, the sponsor of the fund, State Street with X or T or whatever, right? Yeah. They basically are kind of like the fox guarding the hen house, because they can say DTCC, hey, we're good for it. So go ahead and credit, market maker, or backup. Go ahead and credit authorized participants, account. however much of the underlying, because they just redeemed, however many shares or whatever, right?
Yeah.
And if doing that forces this is, I think, the piece I was missing. If in that transaction more shares are issued, assuming that the market, or assuming the authorized participant who's doing the redemption was sold shares short by another participant, because then you have, another layer of phantom, or another layer of syntheticization. Anyways, but you have another one of these things coming in, and that way from I couldn't figure out why they needed to go into the forwards position, because I had just assumed, well, the redeeming shares, okay, well, fine, the assets, the underlying goes away, but so does the liability. But are the redeeming shares that are just created? No, the assets, you need more of an asset because you've upped the liability side. Okay.
Yeah.
Okay. And then the way you get away with dotting your I's and crossing your T's for regulatory purposes is you have something to say, hey, listen, we've got the shares coming in. We're good for it, DTCC. By your own rules or whatever, right? And even those rules are lax and loopholeable. Who cares? Did you see the DD that dropped? I think it dropped, Josh, when was it, like June of last year? It's when we were going over last week. It was the one linking crypto.
Yeah, so I'll just tie this back to a friend of mine. I was talking about GME, and he's a big crypto guy. So he says, you know what, I'll put on a position. So he says he was going to put on a position through MGME, which is through the crypto exchange.
Yeah.
And I was like, oh, that is really interesting. Do you think he could walk me through that? Because I didn't know you could go long in crypto. And then he says, Bill, this is weird. It looks like they took off GME off these exchanges in the crypto market. And I said,
I mean, isn't there still a tokenization for GME through like Bittrex and FTX or FTX?
They took it off.
They took it off.
And they took it off January 6th.
Interesting.
And that is when
this year?
Yes.
Right before XRT was thresholded?
Also, right when utilization started to start spiking. And we see all these other metrics start to shoot up that they weren't using before. And the reason why we don't think they were using them was because they were going short in GME. I mean, they were going short in crypto, and they didn't. I mean, that is a joke of how much leverage you can use and how little it's tracked. So it looks like if that got taken off they can't go short in crypto anymore, then they're going to have to start to use these metrics that are seen.
And just let me put some more context on that. If you go back to circa March 5th of last year, there was a change that was put up for, the way I read it was, what's acceptable collateral to post. And so, like, if you're going short a bunch of shit, you're actually going to have a cash problem, right? Or cash too much problem, right? Because you're selling stuff you don't own and you're getting cash. So you've got to park the cash. And this is what that DD, I wish I remembered the author, because, this is not me. This is credit.
Parking the cash in, like, what, BTC?
So, no, they were parking the cash in the crypto casino. It was the argument, because like if you can whipsaw the crypto market, so let's say like you're big enough and there's not enough regulation where you can basically whipsaw BTC, Ethereum, and like especially some of the smaller alts or whatever, right?
Yeah.
So what you would do is you would enter, so you would stash the cash in crypto land, and then you would pump BTC or whatever, BTC, ETH, or it doesn't matter. You just pump something that you can go into a futures contract on. So you do that, and then you pre-sell your BTC or whatever at the pump price. And then at the same time, so you're agreeing to trade, your Bitcoin, whatever, for like Tether or whatever, right? Some dollar equivalent or whatever, right?
Yeah.
And at the same time, you also then enter into it. Let me make sure I get my sequencing here right. You also enter into a future agreement to take delivery of GME based off the high prices of so you're exchanging BTC or whatever, right? But at the inflated price for, the synthetic GME. And that synthetic GME, at least up until like, circa May 2021, I think was acceptable to say, hey, listen, we found a locator, or we have satisfied, we are not short because we have fulfilled our obligations through this, bullshitty thing over here. Remember like the picture I drew before, like all those like wacky things, it got wackier and wackier and wackier. The other thing, like Josh and I were both started with this, from the looking at the banking system, and not to bore you with that, but the interesting thing on that is that you've seen this thing that happened, with a super stock. And just a side note, it means you're over the target is what it means. So keep up the good work.
Thanks. I appreciate it. Yeah, there's definitely money to be made off of the systems that they're pushing on that subreddit. So I'm happy to be out, honestly.
Yeah. But anyway, so the thing is that all this cash suddenly had to leave crypto land. And if you look at when one of the more notorious, or not notorious, but one of the more high-flying alts, Cake or whatever, right, on the Binance Smart Chain started to deflate, it happened almost right after this. It's also the same time you had this facility that the Fed's running called reverse repo pickup. And so my guess is, or this is my pure tinfoil hat speculation here, is that when the cash came back out, the cash then had to be parked somewhere, and the banks themselves didn't necessarily want it to be parked on their balance sheet for their own various reasons of how they have to maintain their own ratios. And so therefore it was stashed into the reverse repo program, which basically gave collateral in the form of treasuries. And this gets back to the collateral question, because theoretically, at least in the banking system, the most pristine collateral you've got, short of gold, is US treasuries. and someone in earnest started. Josh, help me with my timing. It was RRP picked up end
May.
of in May, right? Right. It really started in earnest, and it keeps going up and up and up.
We noticed, and maybe this is something you guys are more familiar with on the banking side. Like my background's like fund strategy. We noticed that the FedWire on our OPEC dates went down last February,
Right
in
before,
November, and right before the run started, and in just now on the 24th, where we saw nothing, right? But we did see those new rules come in. Very well timed, might I add. But I'll get into that in a second, I guess. But with the FedWire coming down, I'm wondering if the Fed is squeezing Citadel's very large known short on they have a large short on the treasuries. And I wonder if the Fed is asset repurchase program, they're buying into those treasuries and squeezing Citadel out, and Citadel's making up the margin elsewhere by covering other short positions like GME.
That could be the case. The other thing, too, I would note is that when the Fed does its repo program, it's lending out more treasuries than it actually has on the books. So it's financial engineering, because that way someone who might need to post treasuries as collateral can say, hey, listen, we've got IOU treasuries from the Federal Reserve, and nobody beats the Federal Reserve.
Yeah,
Also,
same as cash.
Yeah, and there was also the thing too where the reverse repo. Josh, do you remember this? It was they also are doing it with equities now. The Federal Reserve came out and basically said you can do reverse repo with equity. So in other words, like if you need to post GME, you basically have an IOU GME from the Federal Reserve itself.
Is that actually Fed backed, or is that just a standard repo agreement?
It's Fed backed in the sense that the Federal Reserve is saying we will find some way to give this to you, and people trust that the Fed will have the wherewithal to find some way to give it to them.
Interesting.
So,
and
I don't
like the mechanisms behind it. So just on the Fed's balance sheet, if they have, call it around $300 to $400 billion worth of treasuries on their balance sheet, but there's over 1.4, I think $1.7 trillion in reverse repo. When you do a reverse repo, you are getting treasuries on your balance sheet. So how is that theoretically possible if the Fed is 400 billion and they're giving out over 1.7 trillion a day? The only explanation is that they're giving out more than they have. So they're saying, an article just came out from the Fed that they said they will do the exact same thing with shares if there's ever a circumstance where it's needed. If there's more shares, or if they'll take that same counterparty, and you can go to the Fed and give, like, basically do a reverse repo where they'll give you shares of GME for you pick the price and they'll give it to you. Well, not pick the price, but the market price.
Interesting.
Yeah, the other thing too, and this is, I don't know, the only DD I've ever written for a super stonk was looking at, so when you look at the OCC, when you look at the DTC, the NSCC, or whatever, COMEX would be another example of it. They're considered DFMUs, designated financial market utilities. Basically, the government's not going to let them fail. And
they have accounts with the Fed.
Yeah, and so the reason that's important is that many people think that the Federal Reserve can print money. They actually cannot print money. What they can do is that if they have a willing financial institution to launder the money into existence, or into money that you and I can spend, that's doable. So think back to COVID and the PPP programs, the payroll protection programs. You had commercial banks like, your local bank or a Chase, BOA, whatever. They would issue loans. So this would actually create the dollars you and I would spend. And then the loans would be bought up by the Federal Reserve by swapping the assets. In other words, a loan is our liability, but it's the bank's asset. So the Fed would say, okay, bank, listen, give us that loan, and we in turn will give you bank reserves. And that's how they can backdoor money into the real system.
Yeah.
And I think that's one of the things you're going to see happen is that if, this thing does, when this thing does blow up, whether it's the OCC or whoever is failing, whatever, right, they would basically just write the Fed an IOU. The Fed would send over bank reserves, and those bank reserves would be used to generate liquidity and, send money into the, at least that's what I think would happen, and I think the Fed knows.
That's pretty close. I mean, if you're talking about system-wide failure on that level, up to the clearinghouse, then yeah, right.
If this thing blows off, do you see it actually? Do you think that the primary dealers will actually be able to keep it from feeling all the way up?
It's tough. If the primes are going to issue a share recall on whatever outstanding short positions are on GameStop, which are likely packaged in total return swaps.
Do you think you could explain that? I'm not entirely sure what that means.
I mean, so they're obfuscating their reporting by holding total return swaps to the value of GameStop. For someone who wants to be long GameStop, right? They have this massive net short position that a counterparty could buy, essentially, right? And that just keeps them from reporting that short interest percentage, right? And so whatever short interest percentage was left over after the events of January, which was likely a significant percentage, was just moved forward into swaps and or forward contracts. It's possible even that since the ETFs, and this is a little tinfoil hat, but since the ETFs they're using to create this, it's almost like a Rube Goldberg machine for liquidity, or volatility. Really, it's not. So it nets out zero, right? But what it does create is volatility. But since by using the ETFs, they've created a buyer for their net short position, right? Because now they have someone who wants those forwards, and they can provide them, and slowly bleed off their negative balance position to the ETF that they're using to drive the volatility and the underlying that they profit off of.
So would they be throwing their short position onto the ETF instead, or would those ETF synthetic just be getting destroyed?
Well, so the ETF now has a negative balance, right? After the creation process, their NAV is no longer in line, and they need to bulk back up essentially their free float, right? Actually, if you look at XRT back in January, it almost blew up. Their free float went down to like 1 million shares. There was so much creation taking place. They almost blew the fund up in order to continue facilitating this process. But yeah, essentially by leaving the ETF short GME shares, they create a buyer for that short position. Does that make sense? So they have this massive negative balance of GME, and they need someone to want to purchase that GME. Right, and then they can create that opposite position through the ETF.
They're using the ETF to go long or to sell their short position too.
Essentially, yeah, to become the buyer of their
short position. Exactly.
So let me just see if I can add on to that. So that means that when the short position that's held by a certain, let's say, Mayo enthusiast collides with the long position of the ETF, they just cancel it. It just blinks out of existence, right?
Sort of, yeah, essentially. Or the reporting thereof. I mean, shares of GameStop still have to be purchased, right? Because that swap closing means that
it's
shares
just on
have
their
to be purchased.
It's just like the balance sheet masturbation that they get to do.
Yeah.
Oh man, that is fascinating. Just for the viewers there, if you're not following that, basically what he's saying is, if I'm getting this correctly, the Citadels or these
no names.
Yeah, these no-named market makers or hedge funds, they will use these ETFs the hedge fund will sell their short position to the ETF, which is basically the ETF is going to buy GME. The hedge fund is going to buy GME from the ETF, which is going to print those shares.
Yeah,
if I'm getting that correct.
And then when the FTDs finally come due, right after and I've discussed in my DD how they mark them long and we see this massive put interest start to build up on XRT over the course of the quarter, and then it all dumps on the OPEC state as they cash settle out those FTDs. Those FTDs are now ETF FTDs, right? Because the FTD is due for the whole creation basket, and that's one of the reasons we see the short across this whole sector and not just on GME itself, because it's not very profitable for them to only pull GameStop when they're pulling these baskets, and they can, but they have to constantly return and shave off the rest of the shares, and they can lose a lot of money on arbitrage that way. So it's better just to short retail instead of just shorting one stock, right? I mean, they expect it all to fail. Like we see the same thing going on with Dillard's, BBBY, Macy's, Nordstrom's, all these other, I said it once, you go into a mall and throw a rock. If you hit it, they're short it. And so through this mechanism, not only can they get rid of these massive over short positions taken by entities like Melvin, but in addition, they get to use this system to fuel a long short volatility positions basically the borrowing and settlement of this create large surges of volatility in the underlying. And so during the short process, they can carry these short variance swaps where they're short the volatility. At the bottom, when entropy on the underlying asset is very low, they can place an entropy swap. Then, they redeem all of the obligations in the basket, which causes massive price action in the underlying. The entropy swap is net neutral, gamma positive. So they make money off of the underlying going up, right? And then they close out the entropy swap. And at the peak, they still have that short variance swap open. So volatility now very high and only going down. And then they can now short the peak of that price action, right? So they're getting this like massive delta value out of these synthetic short positions. They're getting, they're building that constant value in the short volatility position, and they didn't lose any money on the way up.
So what actually constrains them? Like, what actually is a roadblock to these guys?
So the way we figured it out is their highest risk is volatility beyond fighting against other entities to bring the price of the stock down. And so we determined that, retail holding long dated high delta value call contracts, high notional vega value as well. So the further dated the better, but retail's poor, right? So they can really only buy like a quarter out. And what this does is it creates a massive spike in delta sensitivity. And so when they run the price, even though they're gamma positive, there's it moves beyond the limits of their expected price action, right? And so they can begin shorting, but now they're shorting into the market maker's positive delta hedge, right? And so if provided retail had enough delta carried across, however many individual shareholders, if they were to choose to do so, the potential is they would not be able to short into that delta, that positive delta pressure, and their short position that they build at the top would be blown up, which would then start to blow up the rest of the position, right?
So basically, it takes a monster to take down a monster. In other words, you've got to provoke. Okay, I'm sure. And this gets back into your thing about the Rube Goldberg machine, because if you have another monster that comes in and just blows up one part, I mean, it might be very sophisticated and it might be very effective, but it also seems like it has to be very precise. And if something...
Yeah.
Let me... Oh, Josh, yeah?
No, I was going to take a different turn. You go, Justin.
Yeah, so one of the things Josh and I have been talking about too, and this is kind of the vibe that I get, I'm just curious to run it by you to, for a smell test on this.
Sure.
Yes or no, would you agree with this general sentiment? They're running out of options. They might not be on their last option yet, but I don't think this is their first choice. And if it's not their first choice, that means that something is otherwise precluding them from exercising their first choice.
I mean, their first choice would be to cover, right? But retail stopped that. Retail kept buying. And even though, I mean, everyone's going to say they're diamond-handed, but people have sold, right? Of course. But, retail holding has prevented the buying of the underlying in any great degree. And so through this process and the shorting at the top, they can average down their old short position, right? But, if you're shorting the stock at 250 every time, then all of a sudden, if you can build up enough volume over time, then all of a sudden your $5 shorts don't look so bad anymore, right? Because you're averaging that position up. And then if you're bleeding off that average into these ETFs, so like whatever you use on these runs, you're bleeding that off through the ETF settlement process. Then, really all you're doing is effectively averaging up your short position nearer and nearer to market value over time. And so, everyone for a long time thought that they had no way out. And this is probably the way out, but it's a slow trickle. But, without any massive institutional, now high volatility means that big institutions, big longs, they don't want any part of the stock, right? They're not even going to consider it. They already consider it significantly overvalued. And so, we're not going to really see them come in. And so they're in a very safe position to do this. I mean, you see them do things that would be considered very high risk on any other asset, right? Where like opening bell will hit and they'll buy out of the money puts. They'll borrow 300,000 shares. They'll short the stock straight down below the out of the money puts. And then they'll use that market maker's negative delta hedge in order to cover their FTDs in a lower price channel for the entirety of the day. At the end of the day, they'll close the puts out when CNS closes and the price rises back up. And they'll do this day after day after day after day until they get these FTDs settled out on any shares of actual GameStop that they had to borrow.
It's always that like it spikes up, U's down, and then runs up into close.
Yeah, I mean, go look at GameStop's price action for the last
Yeah.
9 months, and you'll see it almost every day.
Yeah, and
CNS begins at 8 a.m., ends at 3:10. If you look at GameStop's price action after 3:10, there's very high correlation with improved price performance from 3:10 till market close.
Yeah, we know you don't like to direct register your shares, and
No.
and there's absolutely nothing wrong with that, because the way they're shorting, there's really no effect on if.
Yeah, I mean, so even with 100% share registration, technically at 100%, which I think is very unlikely, because you'd have to register all of the shares that the DTCC considers to exist, right? Because as long as there's institutional owners, you could never really own 100% of the float, right? Because they have the shares registered in their street name, and so. And the method they use relies on no locate, and so the idea of pulling the share certificate back from the DTCC and onto this digital ledger at the transfer agent is to stop these broker dealers from borrowing or lending shares, right? But as long as the DTCC sees shares in their equity pool, they're going to say that they have a locate, and you know. And ironically, they also see shares from their fast agents, which, you know, ComputerShare is one. There's more to that, but
there's the reason why I really like direct registered shares is because there's a rule that Justin really found that you can't. I think you could play on this a little more, Justin, that you can't sell if it's over a certain amount. And if the squeeze was happening, then it would exacerbate it, because retail is forced to hold their shares. Because
yeah. I mean, a lot of people, if you go on my Discord ever, we'll talk about it. And I don't approve of the infighting, because I do agree with Trimbath in that direct registration of your shares, enforces your rights as a shareholder and you know, empowers you. I just don't agree with it as, you know, a catalyst for anything. The SEC is well aware.
There's no catalyst. I just think it could exacerbate the actual MOAS if it were to happen.
Oh yeah, it could, because it creates share lockup. I mean, this is kind of what we had with Volkswagen, right? Porsche had all the shares, so and that's where the comparison to Volkswagen and DRS would lie, because the Volkswagen squeeze was intentional. Porsche short squeezed Volkswagen very publicly and very intentionally. A lot of people think that like it was this sneaky thing and it just happened. No, Porsche did that on purpose, and they made more money off that short squeeze than they did in the next 5 years selling cars. But that share lockup meant that Porsche chose the price. With individual shareholders, that's harder to say, right? Like but it does create share lockup in the same way that, you know, somebody who's dead and their shares are in trust would create share lockup. And I think you saw that with DGAZF, the ETN. There were several people that just owned that ETN in trusts, and they were unable to get access to those shares, and so it kept squeezing while they were trying to like locate these shares. But an exchange traded note is different. You can't FTD it. There's no synthesis possible on it. So you can't synthesize shares of an ETN. So that situation is probably not the best comparison, but it is one.
One of the things I think that's going to be a hallmark of this, and like I don't know how to say it in advance because you can only see it in reverse, but you can talk about the concept going forward, is emergent properties. In other words, like GME starts to run or whatever, right? Then you have all of retail running onto computer shares, but they can't figure out how to sell, or like, you know, something stupid. Like it's like to use dark humor, it's like a plane crashing. Planes don't crash just for shits and giggles. It's this dark comedy of errors that all come together at the right point in time. And so I'm really curious to see, you know, what goes on here is that even if retail wanted to sell, or let's say, you know, people sitting in, you know, computer shares, they just didn't know how to do computer shares go down. And at the same time, you've got, you know, the option market makers coming in, you know, to cover their delta. Well, you know, the shorts having to close, you get this crisscross back and forth.
I mean, I've traded probably 3 really big high volatility events since I've started trading my own capital. And like a few years back, I decided to, you know, day trade and practice that while I was doing my real job, and then got enough capital together, and that's what I've been doing for the last 3 years. But I traded the Volkswagen back in 2018, the 2020 COVID crash, and then the GME squeeze, and all 3 instances I had brokerage outages. And so now, I mean, even today, I hold my GameStop in almost 6 different brokerages, because none of them are guaranteed to be live. And when you have that rush of users come in. It has nothing to do with the brokerage itself. AWS can go down. I mean, you have so many people flooding into the market participation at once. And then for me, can computer share handle that? And I mean, it's not a big deal to have some shares there. For me, like if I wanted to transfer some shares there, I wouldn't really care. But I mean, like they are not a brokerage, and for me that presents risk.
There's such a big position in computer shares and no one can sell. That is just going to that is why we think it could exacerbate the squeeze so much more, and why we love it so much.
And the other thing to add on to that, just layer in the geopolitical situation, because if you think that our friends in Russia don't have, I've got to choose my words carefully here.
Don't say anything bad about Putin on YouTube.
Yeah, okay, let me be very careful here. So there are multiple vectors to send aggression from one party to the other party. Generally, we think of like bullets being kinetic, but financial warfare, a strategic hack, like Fedwire going down,
yeah,
point or whatever. And if there's pandemonium going, because I keep saying this, and I don't think that I don't sense the collective zeitgeist has gotten it, but this thing going, GME blowing up's not happening in a vacuum. GME blowing up's happening against the backdrop of market chaos, and that's going to affect a generation that is on the cusp of retirement. Unlike 2008, they don't have another 10, 20 years to stand around holding their junk, waiting for prices to rebound. Like this isn't happening in a vacuum.
And I mean, if BlackRock holds a lot of this, and then they're owned by Vanguard, that's really gonna blow up the pensions, and it would just be a tough situation for everybody.
I mean, I think entities like BlackRock, Vanguard, Fidelity, they're going to be Schwab. They're going to be safe. I mean,
they're going to be bailed out.
I mean, I don't even think they could fail. I don't care how big the squeeze gets. I mean, the federal government would shut it down long before it starts to affect the valuation of the dollar, right?
Yeah, and if I jump in for 1 second too, like not to get geopolitical or anything, but I actually think that when you look at what the federal government's interests are, I think that they are more aligned, or there's more alignment there with GME squeezing than other people think. And because the reason for this is that if you have a massive event, it gives the federal government, particularly the Federal Reserve, the pretext to go in and say, oh, heavens to Betsy. Well, we'll just have to bail all these people out, and we'll just collect, what is the national debt right now, including our off-balance sheet liabilities? How many billions of dollars? Well, okay, so average tax rate 30%. Yeah, we wish we could do something, but
I mean, they're going to pack up all of that into 30-year loans, and they're just going to make money off of those entities forever because of it. Yeah, I mean, similar to 2008 when they bailed out the big banks, right?
Yeah.
So yeah, no, I agree. I agree that the government won't step in unless it presents catastrophic risk to the system. But if it does, they will. And that's something about computer share and that share lockup that could occur. Is it could, right? Potentially, like it could squeeze to limits where it could affect the broader economy and become a contagion. Especially with with this ETF issue, if that side of it blows up, that could really, destroy everything.
And I would just like to hear a rationale behind this, because I'm not too sure if it's correct or not. With these option makers, are their algorithms set up in a way where they have adjusted the average amount of calls that get exercised, or is it going to adjust out? Like, let's say,
are you referring to their delta hedging? Their delta hedging strategy? So it's pretty common for market makers to take a delta risk.
Yeah,
but it's by asset. Some assets are exercised more heavily than others. I do think that they do, and that we provided evidence that the market makers do not hedge fully, but that's also where the market makers are exposed, right?
But so is it correct to say, let's say if usually around, like, call it, I don't know the numbers, but say 1 to 5% of these calls get exercised on a regular stock, but during the squeeze, if like 20% of calls get exercised, would that cause the option makers to really go down?
Yeah, and this is something I discussed as a strategy in my book of MOAS DD. I don't know if you guys have read that, but I wrote like a big 3-part DD discussing how to counteract like what I was seeing at the time as these hedge fund strategy. And exercising of options was a very big part of that, because you don't need to buy in the money options and have cash on hand to exercise them. You can cashless exercise, you can exercise and sell to cover, and you already have somebody who's providing the catalyst for price action to increase the delta value of those calls, right? So you already have somebody driving the price up for you. And so you can just hold them, and then if it squeezes, you can exercise.
And there's a follow-up to that. So the option market makers, I'm just assuming that they're neutral in all of this. They're not trying.
They should be, for the most part.
And I'm also assuming that I can't remind anything that they're acting in good faith. All they want to do is make the market for options. Okay.
Yeah, I don't see any reason for Wolverine to have interest in the short side of GME, and they're the CBOE market maker for GameStop.
So let me ask a follow-up question for this. Do you think that GME represents I don't even know the word used, idiosyncratic, or back up, that
idiosyncratic?
Idiosyncratic, like that when you look at GME, like for the options I have, my goal is to cash out, or my goal is to take delivery of the option, or to take delivery of the underlying. That's what I hope to do. And I might have to, sell one or two in order to raise capital to do it, but that's what I want to do. And I can't be the only one who wants to do this. So my point is that historically, these guys, I'm not saying they're very smart. They have excellent people working for them, I'm sure, but they say like, listen, historically it's, 5 point whatever percent, that's gamma. Is that the right way to say it? That's the ultimate gamma that we have to use our delta hedging so that we don't get caught behind that, right? Yeah. But in GME's case, if you have this anomaly in the system where it's like, listen, the past historical averages don't matter, and if it's off by, let's say, let's say the number of 5% is the historical average, but let's say it turns into like 50%, what happens?
That's catastrophic risk for the market maker if they're especially if they're taking a delta or risk on delta, right? Because the OCC doesn't even have a provision for. So they can't create or synthesize shares to satisfy an exercise. There's no bona fide market making provision. So the only two sources to obtain shares are ETFs, right? And buying on a lit exchange. And they have T+2 to do it. So if you imagine it this way, imagine, they are net short and like a 0.9 option is being hedged with a 0.5 or 6 delta, right? And that the counterparty exercises their rights to that contract. They either have to double their loss and go to an ETF, or they have to buy on a lit exchange. And it is in fact like a tiny margin call for that missing delta value. So if they have not hedged appropriately, now all of a sudden you've created all this demand on this illiquid float. Yeah. So that, I mean, absolutely. I 100% agree that it is a strategy that if retail ever got the opportunity to employ, they should, because it would just squeeze out of everything.
Personally, I only trade options. I don't even own any GME shares. I just got into GME like a month and a half ago. Justin's been hammering this down.
You picked a terrible time. Unless you bought at 87, in which case, good job.
That was pretty much like I was very lucky. Justin, he put a pretty massive position size on, and I was like, holy smokes, like, let me start doing some research here, because I was like, these are just meme stocks, like, I don't care. And I think that's the majority of people. They just don't care about them, and I didn't care at all. Until you really start to dig like incredibly deep into this stuff, and then you realize that there really is something here. So I only have options, and I plan on trading all these cycles. And I think that is what most people, their plan should be, because even if this MOAS never happens, if you are playing these cycles and 10xing your options throughout,
I mean more, right? Because you can buy options on like the peak of entropy, right? When entropy peaks on each cycle, you can buy into long contracts. If you have underlying shares, you can sell covered calls at the top, hedged by your long options. You can then bail on your long options and buy puts. You can sell covered calls at the cash secure puts at the bottom. I mean, it's just, you can just make money.
And that's the plan. Like, you always have, and then if MOAS does happen, you get incredible gains. So there's really no downside. If you can really dig deep and understand these cycles, then you can make astronomical gains, even if MOAS never happens.
It's hard to say this, but I moved into GameStop in last November, a small position, not large, a chunk of options contracts in like 500 shares. It was cheap at the time. It cost nothing. And then in February, I took everything I made in January and put it right back into the stock. And I did great in March. And then, I did phenomenally in June. And then once I started to understand these cycles and really dig into this, I haven't made a penny since.
That's how it works.
No, it's become difficult, more and more difficult to track. They know that we know, and so they're doing
they know that we know that they know
the cycle. Like we saw this last week, these rule changes come in, and the stock should have ran. Someone is holding a bag right now for a massive amount of exercised in the money puts that were closed closed out. We went from a 3-to-1 put to call ratio to a 1-to-3 put to call ratio last Friday on February 18th, and somebody's sitting holding the bag for this, and they didn't settle in T+2.
Yeah, and so could that just be like if someone were to fail in a circumstance like that, then they'll have their they might have extra time because they are going to get margin called.
Yeah, so FINRA gives 15 business days. We may see the price action Monday, and my understanding of FINRA's holiday deferrals may be incorrect because I've called FINRA and they don't know. I'm not kidding. I've called like 5 or 6 people there now, and everyone I have asked has given me a different answer for how their holiday deferment works. So like the real question is was Friday the 18th moved? Was yesterday's Friday the 25th? Was that the +2 day, or was that the final settlement day? And they don't even, half of them don't know what T+2 is. The rest of them are like, oh, it's probably due, sometime soon. And then, I had one guy tell me that, it was probably just due on the 18th. And the orders had to have been placed on the 18th, but then, they could settle those orders for up to like 15 days, which doesn't make any sense. So yeah, I've come up blank, but I think we are going to just go off on Monday. I think maybe they took the margin call instead of covering into the delta sensitivity spike from the 0 DTEs. So you remember, as retail buys more and more out of the money options, not only does that delta sensitivity rise, but the gamma maximum rises, which means that it can sustain higher and higher price levels. And so like if you look at gamma maximum on our runs, you'll see that and this is all Yelia's work. I don't know if you guys are familiar with her, but she created the model for analyzing this, and I just want to give her credit where it's definitely due. But yeah, if you look at our runs, as the price moves up, you can see FOMO come into that gamma maximum. And as long as we don't exceed gamma maximum, our price continues up, right? But once we exceed it, all the price action beyond that point is essentially a volatility spike, because it's no longer stabilized with that positive delta hedge. And so even though we can run, $20-$30 beyond gamma maximum, that's ultimately where like our volume and our price concentration will exist. And so being able to perceive that in advance of a run means that we have a very good idea of how far the runs can move. But when people FOMO, and back to my original point, and that delta sensitivity goes up, they cannot cover.
Yeah, it's
if you watch the delta sensitivity spikes occur from November, when people started buying into far dated calls all through January, as soon as one occurs, they shorten response because they have no other option. And if you look at Friday, and what's interesting about this is I don't even know if a delta sensitivity spike occurred or to what degree. It must have, though, because they shorted GME and every other ETF related stock that we have seen correlate with GME's price action ran. DDS, BBBY, except for AMC, but that's a whole nother issue. But yeah, they all ran and GME was shorted. And so that still has to be covered, and they're out of time. So I don't even know what happens now.
Yeah, right now my current thinking is either we are getting very close to the end game and we are pretty much there within these next month and a half, 2 months. And I think that's a very high possibility. If not, then I think this will probably go on much longer than I could imagine. And that's when, so I have the majority of my position right now in some June calls, but I also have some shorter dated April calls that are at the money playing these cycles. And if we maybe just see the regular OPEX run or nothing, if nothing happens, then that would be kind of back to the drawing board. But I don't really know where everything could be wrong. But if let's say there isn't a MOAS type of squeeze within the next month and a half, 2 months, then I'm just going to focus on playing these cycles for the rest of the time. Do you have any strategy for that yourself?
I mean, I've been, buying far dated calls and then just rolling them as, it doesn't occur or it does. I mean, I have a lot of free capital that I can just throw at moving my options positions forward as I need to. And then I play intraday on GameStop as well, like on that dip to 87,
like 310 every day.
100 contracts and like so.
There was I bought it at 88 and 89.
Oh, nice. Yeah.
Yeah, I lasered in a few. I lasered in a few on that one.
That was a solid floor. Yeah. As soon as we go below delta
Oh,
neutral,
and
or
I know that for myself because I start to say like this is just like it doesn't get better, and then you kind of see the average person, they are all just dumping in, and I myself, me and Justin, I mean, we were throwing capital at these calls, even though we're
yeah.
like hoping it would go lower at some
I mean,
point.
what kind of stock runs like has $40 of price action in a day?
Yeah, yeah,
On almost no volume. And this kind of ties back to the DRS thing, and I don't want to put on this tinfoil hat and say it's why I was banned from Superstock, but I will say that DRS drives illiquidity, and illiquidity drives volatility. And so if there is a nefarious party, they would support the DRSing of shares, because now, you know, as the stock becomes more and more illiquid, their cost in order to generate this liquidity diminishes. It takes far fewer shares to bring the price down, far fewer shares to bring the price up, and if their profits are exclusively on volatility and not on delta, right, then they don't care, right?
mm-hmm.
Like they just want the stock to be erratic. That is where the and so yeah, I mean they would push for more illiquidity if they could.
Yeah, and then their interest whose prop they're making money, then they short, then at the peak, and they're short volatility making money.
Yeah.
It would be much more profitable for them.
Yeah, and so I think even though I do think DRS is an organic movement, I think it's been weaponized by people who realize the value in getting people to do this.
I think at short term, yes. I just think if the squeeze is happening, then, and I think inevitably if this is happening, then the squeeze will happen, and then it will be in their worst interest when no one knows how to sell on computer shares, and there's all these rules and regulations with computer shares going down, preventing them from selling.
And one other curveball in all of this is that, I mean, I don't know how to interpret this. I do a little bit of crypto myself, but if there's a crypto dividend, I would assume that, assuming you set aside the regulatory and legal challenges that might arise from it, so just set that aside for 1 second, I'd assume it'd be much easier to distribute that to people who have directly registered. And I wonder if GME, or if, the powers that be at GME are aware of this, to say, okay, fine, go ahead and encourage, DRS or whatever, right? You'll win. That is, the short guys will win for the short term, no pun intended, for the volatility. But you're essentially, you're making your own bed that you will eventually have to lie in, and there will be problems from that down the line. The other thing, too, I would kind of point out here, and this is kind of, this is tinfoil hatty, but I will just simply note in 1998, when long-term capital management blew up, it was the Russians. The Russians defaulted on their internal bonds, which made no sense. Or LTCM assumed that would never happen because of the printing press.
I mean, don't we see a margin call happening right now? I mean, like, don't get me wrong, but like, I've seen enough of them happen to say that, Thursday we knew obligations were due. They weren't covered. We saw OCC 001 go into effect, and NSCC 001 go into effect immediately with no announcement period. They just immediately enacted the rules, both of the rules handling risk management, and the OCC rule handling risk management specifically on volatility swaps and how they're priced, and how those risk models are managed, and reducing the margin requirements for volatility positions during high volatility events. Do we think that this is someone has, and we see Citadel pulling back their $2 billion from Melvin, who's likely their counterparty in this whole system. So do we see this as they saved them, or do we see this as they're protecting themselves? And I think that's the question that really needs answered this weekend.
Mm-hmm. Yeah, I mean, next week is going to be extremely fun, and I'm sure me and Justin will both...
I mean, there's like 30 million FTDs due.
Tuesday. It's going to be a fun week, to say the least, and I know me and Justin will be in your stream, so I believe
that's awesome that you guys watch. That's super cool.
Yeah, usually if I'm cooking or anything, I'm always in the stream. We don't really comment too much, but I know Justin's whenever we think of some questions on his other account, he'll ask you them for the Sunday live streams.
That's awesome.
So I can't believe we took you an hour of your time. This was...
Oh no, it's absolutely fine. I'm more than happy to help fill in whatever blanks I can. I think I'm going to take some amount of tomorrow's stream. I'm going to open it to like the public again, which I keep doing, and so I don't know why people are still members at this point. But I'm going to open it up to the public, and I kind of want to discuss some of the issues that I see, and try to explain a little better, because I did put that whole section in my DD that you guys were referencing, but I think it really needs broken down more to a level where people get it, because it is extremely complex, but it is also extremely profitable for those interested in that, or extremely criminal for those that might be interested in that, because it's essentially like a bust out scam, right?
Yeah.
Just on a on a physicist PhD level.
Well, the bigger they are, the harder they fall.
Yeah, it's true.
But I was going to say too, if you ever have any questions, like I don't think it's going to become relevant yet, but it might be relevant in the future, is for the banking system. Any boring ass banking system questions, feel free to bring Josh and myself on that, because
Oh, absolutely.
that's more of
Yeah,
I like to think that's more of our specialty.
Yeah, I work for a guy named George Gammon right now. A pretty big macro geek himself. He's a pretty big YouTuber. But thank you for taking your time. I will not
Absolutely,
I can't.
Yeah. No, thank you guys for having me.
Thank you very much, and hope to see you again sometime. Everyone,
Thank you guys. I appreciate you having me. Have a lovely night.